Well, we would like to welcome everyone to the third quarter economic and market update. We've titled it this year, The Change of Focus. A little bit of housekeeping items as we begin this. Everyone will be on mute, and we will have 30 minutes of a presentation as we normally do. And after that, we'll have about 30 minutes of Q&A. So it won't last longer than an hour, maybe a little bit less than that. I'm David Daughtry, one of the advisors at Copperwynd. I'm joined here today by Eric Newton, one of the other advisors, and Jake Eggett, who you all know. Jake usually runs these, and we have to do a great thanks for all the hard work he puts in all of the slides that you're going to see.
For better or worse, right?
Yeah. Well, it's better because you're doing it, not me. So. But anyway, we appreciate you logging in. We're trying it in the evening to see if that's easier or better for some people. And we thought we'd just change it up a little bit from that standpoint. And as we continue, as we have in the past, we'll rotate in advisors of who's presenting. So Karina is off from having to present today or this evening, I guess. So anyway, let's jump into it. Excuse me. The change of focus idea is, and I'll tell you where that sort of comes from as we're looking at it in Q3. If you would have asked us 6 to 12 months ago, are we going to be in a recession by this time this year or by the end of the year? We would have said absolutely. Looking at it today, it's sort of murky, and we'll go into the details of why we think it's not clear and everybody knows exactly what's going to happen. It is clear, though, that our focus last year was absolutely on the Fed. How much is it going to raise this next meeting? How far they've gone? How far do they still have to go? And I think everybody is sort of the opinion now of, yes, they've gone up a bunch, but they're probably fairly close to the end of raising rates. And we'll get into that and the impact on the markets and the economy. So let's jump in. And we're going to do the format a lot like we've done in the past, some questions and then answering those questions. These are questions that have come up a lot as we met with you guys over the last 3 months. And, if at the end, if you have more questions that you'd like us to address at the next webinar, we'd love to hear those. So let's start with the state of the economy globally, because if you look, the global economy is intricately involved in the U.S. economy. And I love colors, and Eric hates colors. He said, why are you going to have all these colors here? But I overrode him on this. This chart is crystal clear, as I'm sure everybody can tell. But the top is months, each month since August of 2021. On the left side is all of the countries, the major countries from an economic standpoint in the world. Blue, light blue, it's above 50, and this is manufacturing purchasing managers indexes, basically how the manufacturing area is going. The light blue and the dark blue, it's going really well and even better. The light yellow and the orange means it's slowing down. And so just at a glance, what you can see is in 21 and early 22, really first half of 2022, everything across the world was really doing pretty well. But it's much more mixed and much more bearish looking right now than it was a year and a half ago. And we're going to talk about why that is and what the impacts to the market are going to be. Now, if we drill down to the U.S., which the U.S. economy is still the largest economy in the world, what you find, and this goes back pre-pandemic, and if you look in the last 2 years, not quite 2 years, we've been in that 2 to 3% range. And even despite the Fed raising rates and as much as they have, it's still been quite resilient. And that level is about what we saw for the previous 10 years prior to the pandemic. So, economic growth, you would have thought it would have slowed down a lot. It's not really slowed down a lot. And we'll talk about why that is. If you go to the next slide, Jake. Retail sales, which are 70%, nearly 70% of GDP, and this is looking at them back from 2014. From 2014 to the pandemic, as you see, it was an upward sloping, sort of steady eddy increase nearly every year. Then we had the pandemic where it plunged, but then when the stimulus payments came, you've seen a huge acceleration for about a year and a half, 2 years there, where all the stimulus payments that came out, people spent, all the PPP loans that went out, people spent. Now with the Fed, tightening the financial markets and also raising rates so that mortgages have gone up dramatically. What you're seeing really now is it's growing, but it's sort of going slow. And all of those purchases post-pandemic are what it caused our inflation. Now, if we look at some of the other areas on the economic side, the labor market. Now, we went back here, over 40 years, and we did that. Excuse me. We did that to show you how low unemployment really is. It's nearly at a 50-year low. Now, part of that is demographics. A lot of us old codgers are starting to retire, and a lot of the young whippersnappers that are 18 to 22 years old, there's not near as many of them coming into the workforce. So this is not just a US problem, it's a global problem. Japan, Europe, Australia, all of those countries are having that same issue. But from an economic standpoint, having very low unemployment is great for the economy. People have jobs, they have money. The other thing is you got a job and are you getting paid well? And what you're seeing is that, and this is real average hourly earnings, which means after inflation. And so pre-pandemic, if you look back 10 years, you had pretty good growth. I mean, sometimes it slowed down, but with the high inflation the last couple of years, we had negative growth on wage growth. And now it's come back, so it's positive. And you're seeing it. You saw it in the UPS numbers, in the new wage contract they have. You're seeing it in the United Auto Workers. So if nearly everybody that wants a job has a job, and then they're also making more money, that's keeping the economy going. Next slide, please. Now, if you go from the income side basically to the debt side and say, well, how are consumers doing? This goes back 40 years, and it looks at debt service, meaning paying all your mortgages and all of those debts as a percentage of disposable income. And what you see is most of the time it's been above 10%. And we're at some of the very low levels of that. And mainly that is because people have 2.5%, 3.5% mortgages. And if they've got that for the next 30 years, financially, they're going to be in pretty good shape. And that also will help us from the standpoint of if we get into a recession, that it will be a much milder recession because people are not going to lose their homes in a big way like they did back in 2008 or 9.
Dave, maybe I can make a comment here. I think one of the interesting things about especially the headlines, you hear a lot about credit card balances being over $1 trillion. And I think it's kind of a tale of two stories a little bit, right? If you own assets like a mortgage, you probably locked it in at a low rate. But, if you have a lot of variable rate debt, credit card balances, I mean, there's been a lot of pain coming for a lot of Americans that are sitting on a lot of credit card debt.
Yeah. And the same way, if you don't own a home, but you're renting, it's not fun at all because the rent, prices have gone up dramatically across nearly every area in the U.S.
Mm-hmm.
So the question is the Fed done raising rates? And that's what we can say is that they're clearly done raising them as much as they had been. They're a lot closer to the very end than they are the very beginning. that's something that's pretty definitive here. 16 months ago, you went from 0 up to 5.5%. And will they go higher? Well, they would have gone higher if it weren't for the regional bank crisis earlier this year. I think they would have gone up to 6%. Will they go up another quarter or maybe a half? Maybe, but that's a far cry from the 550 basis points that we've seen in the last 16 months. So I think that's why the markets are sort of looking and saying, hey, things are not too bad, because they're not going to go to 10%, even though there are some of you guys on this call that remember when prime rate went to 21% in 1981. Now, if you look at the yield curve, this is short term. The yield curve meaning going from 1 month all the way out to 30-year bonds. You look at what the market had it where it was in December and now in August, and it's a lot higher. But that's not so much dissimilar from what we saw all last year. Everybody has clearly underestimated how far the Fed would go at nearly every FOMC meeting since they started. So I do think that we are this yield curve probably is fairly good, especially on the short ones up to the 1 year mark. After that, we'll see. Now, all of that has been trying to raising rates by the Fed has been trying to get inflation under control. If you remember, we've said it many times before, the Fed only has two mandates. One is full employment, and we're, by any stretch of the imagination, we're there. The second is stable prices, which you and I would, of course, say prices don't go up. But what their definition is 2% inflation. And what you can see, and I like going back, 50 years or more here, is that last summer we were at 9.1, which we haven't seen for 40 years. And we put it on here so you can see that that was up dramatically from where it had been the last 20 years. Now, the good news is it's dropped down to a little over 3%. And don't worry if in the next few months, maybe it comes up a little bit from there before it continues down. And the inflation index that the Fed watches, the PCE, the personal consumption expenditure, that's even below 3%. But the Fed's target is 2%. So I think you're going to have them continue to keep rates higher for longer until they know that it's going to get down to the 2.5%.
I think that's kind of an additional question going back real quick, Jake. David, that we get is the target's always been 2, and when you look at the graph, it's not like we ever get to 2 and actually sit there for a period of time. And so is there a scenario where the Fed calls it close enough, right? We're not to 2, but we're close enough. Do they either change their target or they feel like, look, we're done raising rates and kind of let's coast for a little bit?
Well, yeah, and they may, because as we've talked about before, the raising rates, there's 12 to 18 month lag of seeing the full effect of raising rates. And so the problem is they can't keep raising rates until they get exactly there, or they're absolutely going to push us into a bad recession. So they will look and say, have we gone far enough, and are we coasting still down to that? But I think you raise a very good point. When they first started raising rates or talked about raising rates, really in November of 2021, they were talking within 24 months of getting it back down to that. Nobody's talking about, by the end of this year, we're going to have it at 2%. So I think you're right. They couldn't meet the goal. Will they move the goalpost? They might. They might say, it's 2 to 3. But I do think that they will try to not push us into recession before they get it. They'll pull off the accelerator and maybe hopefully coast in. It's not an exact science, and I suspect they'll do something wrong there. It's just not. But good point of, will they say 2 to 3 is good, and they may. That would not surprise me. And especially if you look over the last 10 or 15 years, where you look and you say, well, there were plenty of times that it was 2.5 to 3. Now there were some times that it was -1 or so. But I think it's a good point of, is it going to be good enough? And that may be the case. The other thing, even though they're really close to ending the increase in rates, what they're not close to is getting their balance sheet more normalized where they want it to be. If you go back to 2008, we were basically at $1 trillion balance sheet. After the great financial crisis, when they printed money for nearly a decade, it got up to 4 to 5 trillion. Then when we got the pandemic, it went to nearly 10 trillion. Since then, they've lopped off about 757 billion, and they're reducing that by about 95 billion a month. That will have some direct impact on mortgages and bonds that are longer dated, not just the Fed funds. And they're saying they want to get it back to a more normalized balance sheet. Now, I don't know if that's 1 trillion or it's pre-pandemic 4 trillion, but it's still a big amount of money. If you're pulling out $95 billion a month out of the financial system, it's going to tighten financial conditions. So the Fed funds may stay in the 5% range, but I could see longer term rates maybe coming up to that, because, and you've seen that, just recently on that, the yield curve, where you've seen the 10-year go from, what was it, 3.8 to 4.25. In fact, Eric, why don't you share what you were talking about earlier on mortgage rates right now?
Yeah, and that's a challenge in talking to my brother who's on the mortgage side of the business. Today with the move on the 10-year, which is really where mortgages are priced, they're seeing brand new conventional, good credit score 30-year mortgages at 8 1/8, 8 1/4 almost. And so that is maybe the new old normal, but mortgages are not 2% anymore.
Yeah. But I'm old enough to be able to look and see and remember an 8% mortgage. A lot of my lifetime that's a pretty good rate. So the other thing that's occurring right now, and I briefly mentioned it, when the regional bank crisis started back in March, we had already seen that, and this is a report, a survey that the Fed does of senior loan officers at banks. Are you tightening their credit standards or you're loosening it? If I'm loosening it, it means that I'm loaning out a lot more money. If I'm tightening it, I'm not loaning out as much. And this is only quarterly. In the past 4 quarters, it's all gone up, and now it's above 50%, which, Jake will talk a little bit about, recession and that probability, but that actually has done some of the work that the Fed would do normally by raising rates. If the banks tighten their lending standards, credit shrinks somewhat, or growth of that doesn't go up as much, and that helps the Fed. And so that's why I said I thought without this, they would have gone to 6%. So we'll see. But next slide there. So Jake, I'll turn it over to you on the question that we hear all the time: is the U.S. heading for a recession, and what would that look like if it does?
We are definitely heading for a recession. I think we're always heading for a recession, right, Dave?
Yeah, you're right.
Like a good economist does, they always tell you, an event, but never tell you when, right? So
yeah, you can never be wrong on that, of saying, yeah, we're going into recession, but not put a date on it. You're going to be right.
Yeah, I mean, this has been a really discussion for the last several years. Eric's mentioned it many times, like feels like the most anticipated recession we've ever been involved with. But we've talked about this the last several webinars. And one of the things we showed last time was this recession probability model. Now, this is from the Federal Reserve Bank of New York. And really all this model is built on is what's called the yield curve. When the yield curve becomes inverted, like Dave was showing you, when short-term rates are higher than long-term rates, then you see these spikes in the model. And the reason why they've kind of built this model is because this has been very accurate. Since 1950, it's predicted nearly every recession. Back in 1967, there was one false signal, but besides that, it's been a very strong predictor. Typically, the percentage needs to be around 25%. Right now, we're at 66%, and we would say this is, it's not 100%, but it's a pretty good indicator that in the next 6 to 18 months, typically a recession follows. This isn't the only thing we look at, though. One of the other indicators is from the Conference Board, and what they look at is leading economic indicators, which the yield curve is one of them, but there's a lot of other ones. For example, when you look at manufacturing, which Dave mentioned, when you look at building permits, when you look at the stock market, tends to be a leading economic indicator. When you look at some of the credit tightening and standards, that's another one. And the vast majority of indicators are actually pretty negative right now. This blue line just shows you basically, are these leading economic indicators strengthening or are they weakening? And typically, once you get below 0, you get a warning signal, which is kind of marked by these black dashes. And then once it gets below about 4%, you get really a recession signal. And again, this isn't to say, you always get a recession when it gets below 0. I mean, you can see that there's been several times really in the past 10, 12 years that we've had warning signals, but no recession. But I think the biggest thing to really take away from this is recession risk is very real right now. We may get out of this and really kind of have this soft landing that many have hoped for. And when you look at like the stock market, when you look at building permits, some from housing, when you look at the labor market, all of those things are the things that are saying, hey, we're ignoring this whole recession discussion out there. So when David mentioned about us being a little fuzzy, I mean, if we go back to, earlier this year, we would have, and most economists would have said, hey, we'll probably get into recession later half of the year, maybe early 2024. It definitely feels like that's maybe getting pushed out a little bit, just given some of the good economic data that we've had. So.
And I think kind of going back to your earlier half joke comment, which is at some point they're going to be right. If you say that we're going to be in a recession and you say it long enough, it's actually going to happen. It's just not happening as fast as everybody thought it was going to.
Yep. We go through cycles, and this is the nature of markets. So it's coming. It's just a matter of when, and we'll see. We may skirt through this without one, but all of these signals give us a little pause for when things are weakening. You got to be on top of your game. So let's change subjects. We'll go into what's driving the stock market a little bit. We shared this in our last webinar about how a few number of stocks are really driving the market higher this year. And this is a graph just showing you from the beginning of the year until the end of May, that the top 5 stocks of the S&P, which are Apple, Microsoft, Nvidia, Amazon, Google, I mean, they were up a lot. And since they're such a heavy weight of the S&P, they were really driving the market higher. At this point, the market was up just under 10%, and the other 495 stocks were only up 2%. In fact, the Dow was just slightly positive at the end of May. And one of the things we said last time was either two things are going to happen. We're going to either see these top 5 stocks kind of come back to earth a little bit, or you're going to see the rest of the market start to participate. And so if we fast forward from basically June 1st until now, we've started to see just that, where the other 495 stocks, as referenced in brown, really have started to participate with these other top 5 stocks. So that's actually a very strong signal that the breadth has improved and markets more participants are participating in the market recovery. And so we just wanted to highlight that. I think we're getting a little bit of a pause. We had a very strong June and a very strong July. We're starting to see the market kind of take a breather here. We've had the last couple of weeks where a little bit more negative news, and you're seeing the markets come off of their highs. So let me talk a little bit about just general asset classes. This year we've seen strong results in the U.S. market so far, and we've seen pretty strong results on the international side as well. But U.S. large cap tends to be leading right now, and in fact, we're seeing large cap growth really be the piece that's accelerating the most. So we want to talk about, when you look at the general market trend, it's been higher, especially on the short and intermediate side. But when you look at fundamentals, this is always something that we look at that might give us a little pause right now. So this is the price to earnings ratio of the S&P when you look over the next 12 months. And as you can see, we're at, basically 19, almost 20 times earnings here. And one of the things that's kind of interesting and why we show you this chart is typically when you go through a bear market, usually you come out of a bear market in the low teens to maybe even the high single digits from a PE ratio. You saw that back in 2009. I mean, we were below 10. And so we came through this bear market and we were basically where PE ratios are historically, coming out in the mid-teens, 15, 16. So really not that cheap, in fact, probably more average. And now valuations are starting to get stretched again. So always gives us a little bit of pause and cause for concern when valuations become stretched. The thing we do know, though, is valuations can stay stretched for a long time. We certainly saw that through 2020 and 2021 as well. So going into kind of how we have positioned ourselves right now on the equity side, we have definitely focused, especially in our kind of core equity strategy, focused mainly on large cap US stocks. In fact, right now, 80% of our portfolio is in the large cap side. We have a little bit of an overweight to large cap growth. Earlier in the year, we had a little bit of international exposure. That trend seemed to kind of fade, and so we've eliminated the international. We've mainly stayed in the US. We have a little bit of mid cap, about 15%, and a little bit of small cap. So we continue to see strength mainly in the US. Valuations are actually look a little bit better on the international side, especially in Europe, but they've looked better really for the past 10 to 15 years. US has just trended so much better than the rest of the world. So we'll continue to be dynamic in how we manipulate things. Right now, we're fully invested, and we'll continue to watch our indicators to see if we need to make some adjustments. But that's currently how we're positioned on the stock side. So Eric, why don't you walk us through what we're seeing on the bond side from here?
Yeah, great. Thanks, Jake. And before we get into all the graphs, I think everybody takes a deep breath and tries to embrace the idea that, we're finally back to normal from an interest rate standpoint, which is a little bit of a challenging concept given what we've been through for the last maybe dozen years. But to David's point, as we all are aging, and you look back far enough, the idea that the global financial crisis, the Fed in 2009 sent rates to zero, which we had never seen them do before, and hold them for years. And then you have the global pandemic that comes up, and the Fed then, while they were trying to raise rates ahead of that, pandemic comes along and they put rates back to zero again. It took the global financial crisis and a worldwide pandemic to go to zero. But barring one or both of those of happening again, not saying that they wouldn't, but the reality should be is that we shouldn't be at zero for for years on end or even a decade, that's the abnormal part. So being 5% Fed funds, even if they got to 6%, that's where we're at to be able to say, to David's point, 3% mortgages weren't normal. Now, once they do it once, they can do it again. So to think that they'll never go back to zero for a different reason, I wouldn't put it past them. But that was definitely an abnormal part. So when we talk about opportunities in fixed income, if nothing else, two sides to every coin, at least you can earn money on cash. So we've worked with a lot of our clients for your emergency fund, or you have an upcoming house purchase or some opportunity that you're trying to invest in, but don't need the capital yet. But for the last decade or more, you've earned zero on your cash. Now that interest rates have risen, the notion of T-bills or money funds or even CDs, where you can earn money and not put a lot of money at, not put it all at risk, is a little old school, but it's the new old normal. That is how we feel it should be in a healthy economy. When we talk about the Fed's probably almost done raising rates, again, they may another quarter of a point, maybe a half a point. At some point, they will stop raising and hopefully let us coast into a very healthy economy. They will need to cut if we get into a recession, but the expectation is they're not then going to go back to zero. Big asterisk on that one, but the normal way to manage out of the recession is to lower rates. And so if we're at 5.5, maybe they lower to 4.5 or to 4. But I think trying to wrap our heads around that we just always go back to zero. Everybody that got an 8% mortgage yesterday will refi back down to 2%. I'm not sure that's true. And so it is trying to understand how to shift our investment philosophy, taking a page out of the old playbook of, we have short-term rates, you can make money with no risk, and how do we allocate the portfolio? And so the graph that you see here is an example. There's 5 time frames on the bottom, 95 to 96, 97, 98, where the Fed stopped raising rates and then needed to start to cut. And what this is showing, the blue line is the short end of the investment, 1 to 3 month T-bills, during a stop, no more rate hiking, and you're going to cut, you're earning 5.8%. But as you go out longer on the investment curve, a longer time horizon, longer duration, if you will, which is represented by the US bond aggregate index in orange, as interest rates drop, prices go up and you earn more longer dated issue maturity. And so we're at 5.8% in 96. You can earn on 1 month T-bills. You're earning over 17% on longer dated. I think the aggregate bond index maturity is about 6 to 7 years. And so it's shifting the idea, and you see this time after time, they stop hiking and they need to cut. Now, going back to the joke of we have no idea, we think they're going to be done raising, and at some point they're going to cut. We don't know how long. That they could hold for a very long time, but knowing that we will see some cut. There's never a straight line up and a straight line down. That we need to shift from potentially shorter duration, shorter maturity on the fixed income side and longer and move into longer dated, longer maturity to pick up that yield is where we need to be. And so last year, for example, in our total return, in our bond strategy, for a majority of the year, we were in short-term T-bills as short-term rates were rising. That's where you want to be. Now that we feel like that they're end of the raising, not ready for cutting, but they're at the end of the raising, we have made some changes to the total return portfolio. And really that's the next slide, talking about, you see the asset classes on the bottom, 1 to 3 month treasury bills, the bond aggregate index. Then you get into junk bonds, bank loans, high yield munis, preferred stocks. You see the rate difference. You see the yield on the 1 to 3 month T-bills is north of 5%, but in the junk bond, in the bank loan, you're north of 8% yield. And so we have started to shift our allocation out of the T-bills into the middle part of this to pick up that yield. And so a much different risk profile because on the T-bill side, there's no opportunity for loss holding to maturity. We manage the portfolio within total return differently because there is a downside effect on the junk bonds and the bank loans, but you are trading off a 5% return for an 8% yield. That's the changes that we've started to make. So if you go to the next slide, Jake, really here is the way that we have the total return bond strategy allocated today. 40% of that is high yield. That's the blue. 40% is bank loans. And we have one treasury position that actually matures next week that we are considering moving out of treasuries into one or both of these to extend our exposure to pick up that higher yield. And so I think that's the benefit of the active management within our bond strategy of being able to know when to move out of. Now, again, no crystal ball. I don't want to steal the thunder on the next slide, but no crystal ball on when to be expecting that and trying to get ahead of it. But we've moved out of T-bills into longer dated maturities to pick up those yields. We see that and be able to react to that when the Fed fully stops raising and potentially starts cutting on how we position that. And we're looking at that on a daily basis.
Eric, one of the things that I've seen, and we were looking at a client just the other day that their account that is only in total return. And when you looked at the dividends and interest they got in that last year for the full year, we basically by the end of July had eclipsed that. And another one today that I was meeting with, January, they had like 3,200 in interest off of total return. July, it was like 5,200. So you have seen as the rates have gone up, they've really participated. And I think it looks really attractive at these levels, but who knows what the Fed does? We'll have to see.
Yeah, so the risk, so we look at the risk adjusted return within total return. This year it's not as exciting as watching the stock market. Exciting may not be the right word, but bonds move a whole lot slower. But the risk profile is a little bit different. But again, going back to the good thing about interest rates rising is that we have an opportunity to make money on cash. So if we ever did need to exit, you have that ability. And that the returns across the asset classes continue to change, and we manage through that. So with that, maybe David, go back and kind of wrap up, and maybe this is the results of the survey at the beginning, just trying to understand. So where are we when we look ahead to between now and the end of the year?
Well, I guess what I look at is a lot of times we're looking at what are the risks, because all of our clients pay us to look and be aware of what the risks are. So sometimes in these presentations, we seem like we're very bearish. But I would say that when I look at recession risk, yes, we may go into recession. We don't think it's going to be a bad recession. So, do we head for the hills because there's a recession? No. When you look at Fed policy, they're a lot closer to the end than they are than from the beginning. And so we look and say, we've got higher yields, and that's a good thing for us. Inflation, it's come down from 9% to 3 or 4, and it's probably headed to 2 or 3. That's still a positive. So I think we're not huge bulls of everything's great and it's just going to get better, but we're also not bears. So I would look and say we're cautiously optimistic, and so that's why we're fully invested in both on the bond side and the stock side. But we're not blind to the risks that are out there, and we'll make changes just like we did last year if we see that we need to take some risk off.
So I'm going to share the results. This is you should see on your screen right now, just kind of the sentiment at the beginning. Feels like at least those participating here feel pretty similar.
That looks like what makes a market. Some pessimistic, some optimistic, some neutral. So it's that's interesting to see.
Yeah. So I think We got a few questions that came in during the presentation. Again, kind of going back to the opening, there is a Q&A function at the bottom of your screen. If you want to submit questions, we're happy to talk through. Definitely don't want to forget this. Before we jump to the Q&A, this is the drum that we continue to beat, and hopefully at some point you're gonna cry uncle and say that you're completely on board. So to refresh everybody's memory, Schwab purchased TD Ameritrade. Boy, at this point, years and years ago, they've been working hard to really swallow that company whole. You should, as we all have received emails, physical mail notifying you of this transition, that you're going to get new account numbers. Really everything at TD is going to go away and move onto the Schwab platform over Labor Day weekend. We encourage you to, what we're saying is authenticate you on schwab.com, so that there is a process that we'd like you to go through that you can do now. It's August 16th. You can do this anytime between now and Labor Day. Is log in, ensure that Schwab authenticates you. And really that is to ensure that you don't get any paper statements, you don't get any paper confirms. Most of our clients have elected all notifications to come electronically. If you don't confirm, authenticate yourself with Schwab, they will just start sending you everything in paper. And so we encourage you to log in. If you have problems, anybody in our office is happy to help you. We have been walking through a big chunk of our clients in making sure that you're ready for that transition. If you have questions on anything that you've gotten in the mail, if you've gotten nothing in the mail and no emails, you should please call us, because we definitely want to make sure that you're aware of what's going on. And really from a noteworthy standpoint, in addition to, you're going to get a new account number for every account once it moves to Schwab, and we will talk about this well into next year, is you're going to get 2 tax documents for every account. You're going to get one from TD Ameritrade through Labor Day, and then you're going to get one from Schwab. So for every account that you need to file taxes for, you should have 2 1099s or 2 1099-Rs. And so it is definitely making sure that you have 2 of those when it comes to filing taxes next year. Again, more ongoing discussion, but just wanted to continue to hammer home the Schwab transition that's going to occur over Labor Day weekend. And please, by all means, call us if you have questions, concerns. If you cannot get logged in, we're happy to walk through that with you.
Yeah, in fact, we've had several clients that have just made an appointment, come to the office, and we'll walk them through in the conference room and get it done. So
yeah, probably based on your level of technical ability, we've had clients call in and say, I did it, it was a piece of cake. We're like, great, that's wonderful. For those that maybe are a little bit more technically challenged, happy to do it over the phone, Zoom, in person. Please let us know.
Yep.
So with that, kind of going back to the Q&A, we've gotten a couple of questions. Click on the Q&A button at the bottom if you want to type some questions. I'll tee one up. Here.
Can we do this real quick, Eric? Let's
go right ahead.
So one more poll. We'll start with what's top of mind for you that you'd like us to expand more on. There's a handful of selections. You can select as many as you want. Feel free to answer that, and then maybe while you maybe ask the questions that came through, Eric, and we'll jump to this after.
Yeah. So David, I'll cue this one. One that came up was, so were we in a recession last year? You go back to the GDP slide.
Yeah.
And academic discussion that we had last year is Q1 and Q2 of last year, GDP was negative. And so is that not the indicator of, yep, we were in, did we already have the recession?
Well, and the answer is no, even though a lot of people will say, well, if you have 2 negative quarters of GDP growth, then you're in a recession. Generally, the definition of a recession is the general decline in economic output of goods and services for some period of time. And when we go to the first quarter of 2022, there was clearly good economic output. You were seeing increases in wages, you were seeing increases in corporate profits, in consumer sales. That was really an issue of, you look at the definition, the way they calculate GDP, and it's, you take the goods and services minus imports or exports. If you import, it's something built overseas, made overseas, it subtracts. And if you remember the fourth quarter of 2021, you saw all of these articles about, miles of container ships off Long Beach, off Houston, off Miami, and they were saying they can't get in, and all of the supply chain issues. First quarter of 2022, they did get unloaded and therefore counted against GDP. So that was an anomaly. You could say there was a slight decline in the second quarter of 2022. I agree, but not enough to say we were in a recession. No.
So Jake, another one that came in, interesting one. I had a client ask me this the other day in a meeting as well. But so with the Fed raising rates and interest rates so high, and mortgages going up, should people wait to buy a house?
Mhm. Yeah, well, that's interesting. I mean, the short answer is it totally depends on the person's situation, right? But when you look and say mortgage rates have moved higher, I mean, I would have thought real estate would have come down more than it has. And there's been a couple of reasons why that's not the case. I mean, supply is still very low. I think you have this lock-in effect for everybody that owns a mortgage at a 2 or 3% mortgage. Nobody's moving. I think those are various reasons why you haven't seen real estate come down. But if you're in the position to be able to buy a home and can afford the home prices and the interest rates, move forward. Because if rates do go down, you can always refinance at a lower rate if we see things drop again. So,
and I think Dave touched on it a little bit right there. There's a scenario, don't know what the likelihood is, that another issue comes up and the Fed, inflation doesn't subside, and the Fed has to keep raising rates. And so then you're like, wow, I wish I would have had that 8% mortgage, because now it's 10%, right? You don't want that either. So what the likelihood of that is, I don't know, but it's just one of those. Trying to, if you're waiting on, I want to wait to buy my house until the mortgages are back to 2%, might be waiting a while on that one.
Yeah. I mean, it does go back to, if you can still qualify for the loans and stuff, then go forward. We've always said, don't think of your home as a great investment. It's a place that you raise your family, you live, and you've got to have some place to live, to sleep. And because it can be a good investment, but that's not why you buy the home.
mm-hmm. I think the other thing to kind of mention too is the longer rates stay high, both from the Fed side as well as the mortgage side, the greater pressure that's going to put on the economy, which the more likely we get into some type of economic contraction, right? Yeah. So it's maybe not so much now how long how much more they go up, but maybe how much longer they stay at elevated levels.
Yeah. Well, and trying to play the game of, do you think it's going to go down in 3 months or 6 months or 9 months? Just an old anecdote from my life that taught me a great lesson. In 1981, end of 1980, I ended up taking out a loan to do some construction on an apartment complex that I was a partner in, and we said, let's do variable rate, because rates are got to go down, and we can do the variable rate at 11%. So that's definitely do variable rate. When we finished up 13 months later, prime was 21. Not real smart. So one of the stupid things I've done. But when people say, well, it can't go up that much, or it can't go down that much, I say that's not true. We've seen it go up that much. People said rates can't go to zero or negative, and they absolutely did. So don't try and play the game. If you can qualify and you find the house, buy it. If things come down, you can refinance.
So I think the other question that we get, there's been a couple of questions that have come up, but I know we've had this discussion in client meetings too. I'll summarize is, so if inflation is bad and that's what the Fed is fighting, does that make deflation good? Right? We want prices to come down, so deflation then must be good.
And the answer to that is categorically no, it is not. Our whole economic system is based on stable to rising prices because, and this is what Japan's had for 30 years, it's been a disaster. You think if you're the banker and I'm lending on that house or that building or that business and prices are going to go down, I don't want to make the loan because my collateral is going to be less. So then I don't make loans and things go worse. If I look and say, well, that car is going to go down in price, so let me just not buy it this year. Nobody buys cars, all of a sudden everybody's unemployed. Why would I buy a house today if I think a year from now or 2 years from now it's going to be cheaper? Free enterprise systems, declining prices across the board. I mean, yes, oil goes down, this piece of land goes up, doesn't matter. But across the board, deflation is when the general price of things goes down. It's a disaster.
Going down and going down long term, right? I mean, that's
it only has to go down some if it's everything, because when that occurs, the bankers say, crap, I don't want to lend anything. I don't know how long it's going to go down. I mean, that's the problem. And banks shut down, then we're in a depression. That's the problem.
Well, maybe we ought to talk a little bit more about that, because in our poll, that was the number one topic that we wanted to touch more on: inflation, deflation. The upcoming election looks like another topic we ought to touch on here. So
yeah, well, I would
kind of stealing the tagline from one of the websites that we look at is, over a long enough time frame, all inflation is transitory, right? So it's to say, Ukraine war happened, oil spikes to, what was it, 120? Everybody thought it was going to 150. There was a couple of 200s out there. You fast forward how long we've been in this, 12, 18 months, comes back down, headed back up, right? So there's never a straight line one way or another. It's a bit choppy. It's a lot of the graphs that we have. And over time, everything's going to change. I think, Jake, you and I were looking at the old slide on the eggs where what were we, over $4, or it's like,
they were $6 a dozen.
Yeah, so it's like, but that's come back down. Give it a long enough time, the inflation is going to be transitory.
But you got to be concerned about inflation. If you look like Turkey, I saw it the other day. Turkey, over the last, I think they said 10 years, has the Turkish lira has lost like 95% of its purchasing power. I mean, that's an economic disaster.
And I think that's where the Fed today knows enough historically that they understand the mistakes that have been made in the past, and they do not want to repeat those mistakes of taking your foot off the gas a little too early. I think they would, I'm guessing, Jay Powell didn't call and tell me, right? But I think they would rather maybe overshoot a little bit and have to correct versus taking it off and then have inflation heat back up again, which is what happened, late 70s, early 80s. It's like, push it, take it off, push it, take it off. And then you really have to slam it. And we don't want that.
He called for you, but you were out, so I took the call.
That must have been what happened. So we had a question come in, and we didn't touch on a lot of financial planning within this presentation, but really I'll summarize the question, which is, if you can earn so much on T-bills or money funds, why even mess around with the market? And this kind of goes into, David, a lot of what you used to talk about is if we would ever get back to regular interest rates, and I would say that a lot of what we do with a lot of our clients is trying to understand the bigger financial picture and work that to try to understand how much risk you should be taking, and what your model that we try to break all the time. What you can actually manage to, and you're right. If you can make your model work with us at 4 and 5%, while everybody would love a 30% increase in their portfolio, if you don't need to take that risk and you can find that somewhere else, we absolutely should be looking at what your allocation looks like, and that's really any given day.
But I do think, Eric, along that same line, we can look and we can say for the next 6 to 9 months, we can get, T-bills at 5.25%, money market at that. But when the Fed starts lowering rates, which they probably will sometimes next year, that's going to go down. Where when you look at some of the longer term bonds on the high yield side that are 6.5%, 7%, and they drop rates by 1%, you're going to get that yield, the interest of 6 or 7%, and you may get 6 or 7% on capital appreciation too.
Yeah.
So that's what the chart that you went over of, once they are near the end of hiking rates, you want to move from really short-term liquid stuff into longer-term stuff, because that's where you're going to make the most money. And in our strategy there, I mean, typically our losses have been less than 5% if we're wrong.
I think what we normally try to avoid too is the jerky in and out, where it's like get out, earn 5%, wait for the crystal ball to tell you to get back in, then reallocate rates. I think it's trying to find a little bit more steady state allocation based on your risk versus trying to time it in and out. We're never going to be able to time it, and trying to find that one opportunity. It's a bit of a challenge.
Yep.
I think the other thing I would comment too is this year is a perfect example of a year why, I think going into the year, you could be very pessimistic about direction because of 2022 and how much the market dropped. And yet we've had such a strong recovery, given all the economic stuff surrounding, right? And so you never know, when the market's gonna rally and be looking forward. And I mean, what a big difference a 10 to 20% increase has had on equity markets, in recovering from last year. So,
yep. Well, our time is done. Thank you so much for spending this hour with us. If you have any other questions, please reach out to us. But this will be available in the next few days on our website, and we will plan to have another one in the fourth quarter. So hopefully, if you're in Arizona, things are going to get cooler here. Who knows when? But enjoy your evening, and we appreciate you sharing this time with us.
Thanks, everybody.
you.